Thank you everyone for joining us today for the Q1 Manufacturing Outlook webinar. We are delighted today to be joined by Seamus Nevin, Chief Economist at Make UK, who will be leading today's presentation. We're also joined by Juliet Wallwork, Customs Duty Director at BDO, who will be providing an update on Brexit and key things you should be thinking about. If you have any questions for Seamus or Juliet, please submit them through the chat functionality and we'll pick those up at the end of the session. And we'll be handing over to Seamus, who will kickstart today's presentations.
I'm going to start off with giving you a brief overview of the latest Manufacturing Outlook survey that we've done at Make UK, and then going into a little bit more granular level detail on the findings that we have for this quarter's survey. So to start off with some headline figures. Firstly, output has remained roughly at the same level as we saw over the last quarter. The holding pattern that the UK economy and that the manufacturing sector in particular has been in for the last few months is continuing as the Brexit deadline approaches and that uncertainty continues for the time being. Orders are slightly up after a sharp contraction in 2014, in the final quarter of 2018 rather, but within that we have seen a slight change in the composition. So for the first time since the period of the Brexit referendum in 2016, domestic orders are exceeding international export orders. We have seen a particular decline in orders both from Europe for almost self-evident reasons, with the whole Brexit question being very uncertain, but also from Asia. That's born of two factors, one being the uncertainty that Brexit is posing for our international markets overseas in Asia, where we trade, do an awful lot of business, accounting for about £5 billion a month under EU free trade agreements. But the other side of this is, of course, the growing uncertainty around the potential for a US-China trade war, given relations deteriorating between those two countries at the moment. On the domestic front, employment and investment attentions are both picking up, which is a positive sign. But I will go into that in more detail slightly later on. And on the other side, there has been, thanks to a reduced producer price pressure because of the changes in the value of oil, increased price translated into increased margins for UK businesses, which is obviously a positive after a long period of uncertainty. Our macro forecast, which I should qualify by saying all of the estimates that we make for today's presentation are based on the assumption of an agreed exit from the European Union. That is, that the Prime Minister will pass her withdrawal agreement through Parliament either next week or before the 29th of March 2019, and that we therefore move through to the second phase of the EU negotiations. But based on that assumption, the macro forecast that we have has been slightly downgraded for 2019 to 1.1%, but we do expect a pickup in 2020 at about 1.7%, and the forecast for manufacturing in particular for 2019 is down to minus 0.3%, which is obviously not good news, but we do again expect a big bounce back in 2020, returning to a growth rate of about 1.4%. So looking at this in a little more detail, output is stable, but orders are not picking up. The key point with this slide is the last two quarters. So Quarter 4 2018 and Quarter 1 2019. If you look at that slide, you'll see that the red line, which is output, is much higher than the orange line, which is orders. What we are seeing here is the effect of stockpiling. Many UK manufacturers, uncertain about whether they will be able to secure the import of their input components from foreign markets, are ordering as much as they can before Brexit Day at the end of this month to ensure that they have the component parts ready and able to be input into the various finished products that they manufacture in order to then be exported after Brexit. This is something we're seeing right across the board, with anecdotal evidence from the survey respondents that storage space for manufactured goods for stockpiling purposes has now reached its maximum, and that there really isn't anywhere else to go. The other interesting thing about this slide is, of course, the drop in the middle bit, the part from Q3 2015 right the way up to Q3 2016. That drop is born of two factors. One was It coincides with the period of the EU referendum when there was a lot of uncertainty around the future of UK trade, but it is also semi-cyclical, so there shouldn't be too much read into that particular drop. A lot of what we're seeing at the moment is a combination of the obvious uncertainty around Brexit and our future trade relations with the rest of the world, combined with a general cyclical pattern at this time of year. Moving on to the next slide, UK orders are exceeding exports. This is obviously not a good sign. It's not so much that there has been a pickup in domestic orders, but rather a drop in orders from overseas. That is a combination, as I said a moment ago, of two factors. One is that an awful lot of UK trade overseas, with 75 countries around the world outside of the European Union, is based on the terms that were agreed by the EU with free trade agreements with those individual countries. There was concern in those countries about the potential impact of Brexit on their supply lines, the items that they source from the UK being disrupted, and particularly for those that rely on just-in-time supply chains, that could pose big problems. We have, of course, also passed the date when every export from the UK that now gets loaded onto a ship and sent overseas, if it is destined for East Asian markets, will be arriving after the date that we officially leave the European Union on the 29th of March 2019. And that is creating a huge amount of uncertainty, with firms not sure whether, when their goods arrive, they will arrive under the terms of an agreed EU free trade agreement, or whether they will arrive and land under WTO terms, and the implications for that around product clearing. So if the goods are going to be held in port, whether they will be allowed to land at all, whether they will have to be quarantined for a period, could pose significant threat in terms of time delays. But also the other side of this is the potential for tariff increases. The range of tariffs that affect the manufacturing sector is quite varied, with an average of about 8%, but there can be, or 5.3%, but there can be huge variation between individual components, ranging from the lower end right the way up to 12 or even 15%, depending on the good in particular. What really is borne out from this slide and from the latest quarterly survey that we've done is that manufacturing is a sector that really needs to plan ahead right now. And at the moment, unfortunately, because of where things are politically, the deadlock around the Brexit situation means that businesses are really uncertain about what they need to be doing and are preparing for all potential eventualities. Looking at the next slide, we see a little bit more of a breakdown in terms of the compositional effect within the subsectors of the industry. It's interesting to note that of this, the usual top three trade partners that we have would normally be the EU, followed by America, followed by East Asia. At the moment, East Asia has been overtaken by the Middle East. This is not so much an increase or a pickup from trade with the Middle East, but rather a slowdown, particularly from China. Uncertainty around Brexit is a factor, but the main contributing factor here is twofold. One is the potential for a trade war between the US and China, which is impacting business performance in China. But the other side of this is that there has been a general shift over the last year or so in China, moving away from their reliance on exports, and particularly for finished goods. The Chinese government have tried to change the composition of their economy so that they're relying much more on domestic supply rather than importing from overseas, and that's having an effect on our level of trade with that country. The other side of this is the big slowdown that we're seeing from the EU market. Brexit isn't just impacting business confidence and business certainty in the UK. We're also seeing the UK or the EU market divesting itself of its reliance on UK suppliers, and that is having a negative effect on the sector as a whole. Mechanical equipment is really the only subsector across the whole manufacturing sector which is performing relatively well at the moment when compared across the individual subsectors. Part of this is to do with catch-up growth having performed badly last year, but the other side of it is, of course, demand for products both domestically and from overseas. One of the other interesting things about this slide is the final column on the right there, electronics, which has expanded by about 12%, but is very reliant on export demand from overseas. So the prospect of trade wars, international trade wars, and Brexit, and a wider slowdown in the world economy would be quite disconcerting for that subsector. We have seen, not just through Brexit, but through other factors, including domestic ones, a big slowdown in the traditional powerhouse of the European economy, Germany, as well as in France, Spain, and Italy, which is in a technical recession now, having underperformed for the last 2 quarters consecutively. These are not good signs for the future of the UK economy because of our reliance on exports from overseas, but they're not a good sign for the EU economy as a whole either, and that's a worrying trend affecting businesses quite a lot. Moving on to the next slide, we've seen the producer prices have slowed down and pushed up margins. The oil price surge in Q1 and Q2 of 2018 increased input costs and lowered margins for British businesses. That now has thankfully settled back down again, and our respondents to this survey expect a pickup in price, but not necessarily in margins because of other factors, obviously Brexit related, but also widely connected to the general slowdown in the world economy as a whole. At a firm level, firms are more confident about themselves than they are about the wider economy. This is not uncommon. We often see individual businesses, business people who are more familiar with their firm than they are with their rivals or their competitors, expecting their firm to do relatively well when compared to the companies in their supply chain or their customer base or elsewhere in the wider economy. What's really important about this slide, however, is the final bit to the right there, which is trending downwards in both cases. We expect business performance to be better than in the overall macro economy. When we speak to individual members, that's typically what they say, but that the gap between their expectations for their individual firms and the macro economy has narrowed when compared with historical trends, and this is largely to do with Brexit uncertainty as the deadline for the UK's exit from the EU is fast approaching. On this slide, we can see that output and demand are affecting the way that employers are investing. So at the moment, firms are investing in recruiting extra staff, but not necessarily investing in equipment or other productivity enhancing measures. We have seen broadly across the sector an increase of investment in headcount, with the sole exception of the automotive sector, which for obvious reasons has had negative headlines over the last few weeks, with a number of firms announcing their Brexit contingency plans and their plans for future investment in the UK. Overall, what we're seeing here, though, is that there is a key intention from businesses to invest as much as they can to increase output over the coming months, but that they are doing so in a way that is really hedging their bets in a sense. They're not investing in improved IT systems or manufacturing systems, but rather in headcount, because they want to increase their output, but they're not necessarily certain whether the sunk cost of investing in that output is going to be a long-term advantage to them. So hiring people right now who they can potentially let go should things take a downturn in the not too distant future is seen as a more flexible bet for them. The other side of this, of course, is that they are increasing their headcount in order to increase their stockpiling, which is really something we're seeing right across the board and is at unprecedented levels, the highest level, in fact, on record at the moment. Until Brexit clarity, it seems pretty obvious, but until that happens, recruitment will continue to exceed investment. That's something we're hearing loud and clear from the respondents to this survey. They want to invest, but they want to invest in a way that is sensible and flexible for their business. So hiring instead of investing is really a holding pattern that we're seeing right across the board. There is a possible potential for catch-up growth once that certainty after the UK's exit from the EU on the 29th of March kicks in, when businesses have a much clearer picture about their future trading relations with the rest of the world and with the European market in particular, which is, of course, our biggest market. But right now, the holding pattern that we've seen for the last couple of quarters is continuing with no real change on that front. And this, unfortunately, is not great for productivity, which is something that the UK has really lagged behind our international competitors for such a long time. We're towards the bottom of the OECD league table on productivity and have really been since the financial crisis at the start of the decade. In terms of the respondents' perceptions of the future and what they expect for their businesses, unfortunately, we're hearing a lot from businesses that they're expecting a further slowdown in their performance, and you can see that with again the downward trend in the last few bars. Output continuing to exceed orders. Stockpiling is the real order of the day right now. But looking at the sector a little bit more in detail, you can see the compositional effect depending on the particular area you look at. So the top line here, electronics, it's a real outlier. It's doing very, very well as a subsector. It accounts for about 5% of the manufacturing sector as a whole. But if you take electronics out and their positive performance out of the average for the whole reduces quite considerably. So at the moment, the overall performance for the manufacturing sector is about 0.9% expansion in manufacturing. But if you remove electronics, that number shoots down to 0.3%. So really not a good performance for the other sectors. The other interesting thing here is the performance of that second negative bar, motor vehicles. So the second one down when you look at the ones that are going from 0 to the left to the -2. Motor vehicles have obviously, the automotive sector has been making a lot of negative headlines in the news over the last few weeks. It is a sector that has particularly large supply chains and is the biggest purchaser of metals and metal products. So it will also have knock-on effects if there is an underperformance in the automotive sector in the coming weeks and months. It will have knock-on effects in other subsectors throughout the UK economy, and that could be quite worrying for other businesses. So we would hope to see an uptick as certainty improves, but right now that seems a little bit difficult. In terms of looking at our forecasts for the next couple of years, the column on the left there, 2018, is real data, so that is the actual performance. And what we saw in 2018 was 4 quarters in a row of continuous contraction, which is obviously very, very worrying. Our prediction for 2019 is not great either. But we do expect that as certainty kicks back in and people have a much surer footing on which to invest in their business, we do expect a big pickup in 2020. Unfortunately, while there might be certainty at the end of this month about the UK's decisions on Brexit and what that will mean for businesses, these things typically take a bit of lag effect before they can start to kick in. So the manufacturing sector as a whole is something that is quite nimble and adjustable, but it does take time to percolate through to the final figure. So we expect about a 6 to 9 month lag before things start to pick up again in 2020. So that's the presentation from me. I think there are questions. If you want to submit, you can do so now, and I'll be happy to respond to anything that I can.
Thank you, Seamus. What we'll do now is move on to Juliet's presentation, and then we'll pick up the questions at the end.
Good afternoon, everybody. My name's Juliet Wallwork. I'm a Customs Duty Director here at BDO. As you can imagine, I'm spending a lot of my time at the moment looking at Brexit and what could potentially happen for companies from a customs and a supply chain perspective. So if we look at where we currently are, we have 24 days to go now until the 29th of March, Brexit Day. So what could potentially happen? Well, the first option is that the withdrawal agreement, which was agreed between the government and the EU, is agreed by the UK Parliament, and that takes effect. The challenge, of course, with this is there is a political impasse over this, and we cannot be certain that this will take place. If that doesn't happen, if the UK Parliament cannot agree with the withdrawal agreement, then the legal position, the legal default position, is that we do leave the EU on the 29th of March under a no-deal Brexit scenario. And I'll talk on the next slides about what that could mean. Other options could be that Article 50 is extended. This is certainly the flavour of the news at the moment, and it's becoming an increasing possibility. The only challenge with this is not a unilateral decision by the UK government. It will need to be agreed by the remaining 27 EU member states as well. And whilst there have been positive comments in general towards this by the EU Commission, certain countries such as, for example, France, have made notes of caution, and certainly it's extended that it's expected this would have to be for a limited period and not just to give the UK more time to try and agree the withdrawal agreement. Other options, a second referendum or a general election, but at the moment, given the limited time period we have to go, I think those are probably not as likely as the options listed above. So what does this mean for the impact on the EU-UK movement of goods? Well, Once we leave the EU, we leave the single market, we leave the customs union, so any goods moving between the UK and the EU become imports and exports. And the default position is that there will need to be export and import declarations made to both HMRC on the UK side and the EU member states for every shipment that moves between. Under a no-deal Brexit, we also face the possible introduction of UK tariffs on goods entering the UK and EU tariffs on UK goods entering the EU. Again, there has been some discussion in the papers about what the UK tariffs could look like. The expectation is that initially, at least, the UK would mirror the current EU external tariffs to give businesses some sort of certainty. There is the possibility thereafter, though, that the UK could reduce tariffs on goods coming into the UK. The only challenge with this would be that those tariffs would have to be reduced unilaterally for all countries, and this could have political implications. The other thing to be mindful of is, as of the 29th of March, UK companies will lose access to any duty benefits arising from free trade agreements between the EU and third countries. Most recent example of this being the EU-Japan Free Trade Agreement. Whilst the EU, I understand, was keen for the UK to at least continue benefiting from these during a transitional period, if we get one, I understand that certain third countries like South Korea, etc., have said no, and as far as they consider, as from the 29th of March, the UK has left the EU. So what's the commercial impact? Well, there has been a lot of noise in the press about potential delays at UK ports and the effect that this could have on supply chains, particularly those of a just-in-time nature. There has been references as well to trader assurance schemes, which the government have been pushing as a means of trying to manage trade flows and manage this process. The main one is one called Authorised Economic Operator, which I'll touch on in a bit more detail later on. The other commercial impact is that whenever you put a customs declaration in, it has a cost attached to it. You either do this through a freight forwarder who will charge you on a per consignment basis, or alternatively you can purchase the software that you need to connect to the HMR electronic system through which you put the declarations, but that is going to be additional cost. Because of the fact that the UK will lose benefits to the EU third country free trade agreement, this could have an impact on the attractiveness of UK manufacturers to EU companies. And then finally, pulling all these together, the freight terms. So at the moment, when companies deal in the UK with EU customers and suppliers, they will have Incoterms, contractual terms in place, but these will be relatively meaningless. However, if you think going forward in a world where customs declarations need to be submitted, that brings with it costs and responsibilities, and therefore these Incoterms suddenly become important and companies need to look at these. So what is the government doing from a trade perspective to help UK traders who import and export? Well, since last year, they have been putting out a number of Brexit guidance information, or technical notices they refer to them, and these can be found on the government website, and we've put the link there on the slides for these. They cover a number of scenarios, not just in relation to the movement of goods, but also services, also for people who are living in the EU, UK residents living in the EU, and they are very helpful starting points. From a more trade-focused perspective, the government announced last month that it's introducing something called transitional simplified procedures. It's a way of, and these are going to come into play if we have a no-deal scenario. They are focused on flows of goods into the UK from the EU that go through the roll-on, roll-off routes. Now, this interestingly covers the Channel Tunnel and Dover and routes to Ireland. So wherever goods are not moving in a containerised but on a roll-off, roll-on basis, these transitional simplified procedures will apply in the event of a no-deal Brexit. They will allow companies who are importing to simplify the whole import procedure, so defer the provision of information to HMRC when the goods enter and defer the payment of any duty to HMRC when the goods enter. The interesting thing, though, even though these will only come in under a potential scenario, i.e. no deal, companies actually do now need to register for these. So there is an online registration on the government website, and companies are being encouraged to register for these in the event of a no deal, and we are seeing a number of companies do this, and we're also aware that HMRC, I think, have contacted about 135 companies in the UK alerting them to this. From a wider perspective, yes, we lose the benefits of the existing EU-UK free trade agreements. The government has been trying in the background to go and agree new agreements between the UK and these countries. The EU's currently got 40. At the moment, the government has managed to get in place what are called continuity agreements with a number of countries, which we've listed there in the slides, obviously nowhere near the 40 free trade agreements that the EU currently has in place. Favoured options as well include new agreements with Commonwealth countries like Australia. There's always background noise about a potential free trade agreement with the US, but this is very much watch this space. Just quickly, touching on the trader assurance scheme that the AEO, which I mentioned before. I'm mentioning this because it's something which is a bit of a hot topic at the moment. I have mentioned it previously. It's a voluntary accreditation which companies need to go and get from HMRC. It involves a process of demonstrating to HMRC that the company has good internal compliance procedures and controls over its tax affairs and also potentially its supply chain. I won't go into more detail on it than now, other than one of the main reasons companies are going for this is that it does offer fast-track clearance at ports, which for the manufacturing sector in particular just in time is a very appealing option. Many companies, if you will, are looking at a bit like an insurance policy. You don't want your house to burn down, but if it is, you've got something in place. So it's something that a lot of companies are looking at the moment. So what should companies be doing now? What are we advising to our clients? If you have got goods coming in from the EU, then the first and the easiest thing to do is to register for these transitional simplified procedures. It's a fairly straightforward process. There's no cost attached, and it should help if we end up in a no-deal scenario. The other thing we're saying to companies, look at your supply chain. So really start to understand that in detail. It's not too late to do that. You really need to understand where your goods are coming from, going to. If you have previously dealt with countries under which there were free trade agreement benefits, do you understand what your Incoterms and your freight terms are with your suppliers and customers? Are you suddenly going to get any nasty costs in your supply chain that you weren't expecting? What's going to be your admin requirements going forward regarding customs clearances? If AEO is of interest to you, consider going for it. It's not a straightforward process, and it will take about 9 months from beginning to end, including the time that HMRC take to look at the application and approve it. And also, if you do have fairly complex supply chains, consider things like customs warehousing or processing relief, anything which gives you a duty benefit if we do have a no-deal scenario and you end up having a double duty hit. So just to summarise, these are the areas that companies should be looking at now. your shipping terms, your transitional simplified procedures, understanding your supply chains, considering the benefits of duty reliefs, and also looking at your systems and your resource capabilities. Do you have the knowledge and the capability and the systems in place to deal with the new data, the new administrative requirements that you're going to get from a post-Brexit scenario? And that's it for me. Thank you very much for your time.
Thank you, everyone. We have had a couple of questions come through for Seamus. So Seamus, I'll just read the questions out, and if you just want to respond to them. So the first question, based on the forecast of the pound to the dollar for the coming 6 to 9 months, do you feel these forecasts can be relied on based on the given level of flux?
So we have seen a pretty volatile performance in sterling over the last 2 years or so, largely linked to Brexit. It seemed for a period that any time the government made any significant announcement, it had a big impact on the pound. What we are seeing at the moment is that the market seems to be pricing in an expectation that there will be an orderly Brexit. In other words, that the withdrawal agreement will eventually pass through Parliament and that will have a positive effect on the economy overall. Of course, the other worry here is that if that isn't the case, not only will it impact the pound, but it could also have an impact on the euro if negotiations turn sour. And it is possible that the value of the euro will also slide against the US dollar, even if it gains against the pound. And this could have ramifications for single currency investors or those doing business on the continent, of whom manufacturers in the UK make up a large number. There is a place for sterling in your portfolio, and despite the politics, we still think, are cautiously optimistic that there will be a final deal and a softer Brexit, or at least a less negative exit than some of the markets have priced in previously. If a final deal is reached, we would expect a higher interest rate and stronger pound and a moderation in inflation's expectations. So at the moment, it's probably too soon to tell with any great certainty, but we would be cautiously optimistic that the market is getting it right on the pound at the moment and that things will be roughly stable for the foreseeable couple of months.
Okay, thank you. And the second question we've had, so with businesses stockpiling where possible to protect against the impact of Brexit, how do you see this affecting the supply chain while businesses run down their stock levels if there's no hard Brexit?
Well, we've seen lots of different responses in terms of how businesses are acting when it comes to stockpiling. So a lot of businesses have looked to resource their inputs from elsewhere. So they've altered their supply chains and they've done a real mapping exercise and engaged in a lot of planning around that, trying to see where their stuff is sourced from and how they can potentially mitigate against any potential disruptions should there be a hard Brexit. On the other side, we've seen other businesses sticking to the status quo and sticking with their current suppliers, but really increasing their imports just in case there is a hard Brexit, so that they make sure that they have an abundance of inputs ready to go so that they can continue to manufacture as usual should there be disruption and bide their time out until things improve. One of the downsides we've seen from this at the moment is that there really is a shortage of stockpiling space, warehouse space, left in the UK, and for a couple of the preceding quarters, one of the big investment areas we saw was actually in warehouse construction. That seems to be dissipating now, really, as we're in a holding pattern for the time being. We would expect that if there is, and we are cautiously optimistic, as I said, that there will be a deal in Parliament and the withdrawal agreement will hopefully pass through. If that is the case, we would expect things to get back to normal relatively quickly. It takes the manufacturing sector as a whole about 6 months to 9 months for things to percolate through into final performance and for that to show up in the macro level statistics. But we would be optimistic that in 6 to 9 months' time, after the 29th of March, things will be back to normal and it'll be business as usual.
Okay, brilliant. Juliet, we seem to have had a question come through for yourself as well. So someone's asking, if I already have a duty deferment agreement in place and plans to increase it, do I also need to register for this transitional simplified procedures, or is it the same thing?
Hi, yes, you do need to register in addition to having a duty deferment guarantee. there are a number of criteria that you need to have to get the transitional simplified procedures. One of them is an EORI number, and one of them is a duty deferment guarantee. I think that's the two things you need, but yes, you do need to, it's an additional registration requirement.
We've had one more question come through as well, so Juliet, another one for you. Is there a reference point available that provides visibility on potential import and export tariffs that may be applied, or will this be available via the logistics and clearers?
Right, well at the moment, whilst we're still part of the EU, there is something called an EU tariff, or it's actually confusingly called the UK tariff, which can be accessed online. And what that will tell you is that will tell you the applicable duty rate of your imported item in sterling by commodity code. We expect that this is going to be replicated if duty rates and tariffs come in, certainly initially. So, yeah, there will be some sort of online government-linked tariff or database which can show you what the duty rates are.
Brilliant, thank you. I think those are all the questions that have come through. So thank you everyone for joining us. We'll follow up with a copy of the slides, the recording, and some additional information. So thank you again for joining.